Why is the T-bonds heading down? The downward pressure did not start with the Liberation Day tariff on 2nd of April. Based on this chart, the 30 years long-term bonds chart, the market peaked in 2020, then it broke below its major support line established since the 1980s in 2022. Since that break, the US T-bonds have been on a downward trajectory. So what happened in 2020 and 2022 that sets the bond market on a shaky ground? Why is the recent tariff shock? It is just a continuation of development that began way back in 2020 and 2022. And where are the bond prices heading next? This goes beyond the major holders offloading their US Treasury holdings after the 2nd of April. I'm Kon Hao. My work in this channel is to study behavior science and finance, discover correlation between different markets, and to uncover potential opportunities. This analysis is based on technical studies and does not constitute financial advice. Please consult your licensed broker before investing. By purchasing government bonds, we are essentially lending money to the government in exchange of interest or coupon, with the principal repaid at maturity. A rising bond prices typically signal growing investors' confidence in the borrowers, in this case, the US government. It reflects a level of trust that investors believe they will receive regular coupon payments and return of their principal. Conversely, when bond prices fall after a prolonged uptrend, it often signals a loss of that trust. So what happened in 2020 and 2022 to erode this trust? In 2020, the pandemic struck. The perception was that the US mishandled the crisis, leading investors to lose confidence. Bond prices peaked that year and started coming off. This view was supported by my presentation in 2022, which highlighted an inverted hammer pattern in 2016. When extended, that line became a key resistance level. And in 2020, another inverted hammer formed at this resistance, also forming a double top formation, suggesting a potential peak in the bond prices. Then came 2022, when inflation surged to 9% in June. Bond prices broke below this long-term uptrend support that had held since the 1980s, beginning its downward trajectory. To this day, concern about inflation persists, especially rising political tensions and trade wars, which could reignite the price pressure in the coming months. When inflation rises, interest rate tends to follow, and because bond prices and interest rate move inversely, higher rates put downward pressure on bond prices. Since the confirmed breakdown in 2022, I have been cautious about bond investing. On the trading front, my approach has been to sell into strength whenever opportunity arises. I've drawn a channel using the key peaks and extended it in parallel to form a downward channel. This has served as a guide in managing my bond positions. Generally, bonds and equities have an inverse relationship. We are now facing a unique situation where equities are selling off, and under normal circumstances, bonds should rise as investors seek a safe haven during uncertainty. But this inverse relationship isn't holding up. I would like to hear your thoughts on this. We cannot perfectly time the market, but it is possible to get the market timing right. The market are always telling us on their next move. Stay tuned for my coming tutorial. Remember to subscribe to my channel. Join us in our weekly case study and discussion. Click on my profile icon or description below to find out more. Feel free to leave any comments below. I love to exchange ideas with you on what is about to come. Really happy that you stay through this tutorial. You have many great trading weeks ahead.